So as we sort of run through this episode, we're sort of building a criteria for what you're looking for. So like a concentrated number of stocks in the portfolio, a lead portfolio manager, or maybe a duo, but not a investment by committee situation. Yep. And you also mentioned a small team earlier, and a not too high AUM. Like you want good returns, not good AUM growth.
Yep.
Do you ever boot a manager just because they've got too big?
Yes, I have, and it's very hard, particularly when you run something like Third Link Growth Fund, because when I took the manager on board years ago, one of the things was to ask them to do something for free.
True.
So it's a bit like, it feels like kicking the family dog or something. But there's no doubt that in Australian equities, fund size, as in large fund size, is not your friend. It's a lot easier to manage smaller amounts of money. So, the success of a manager through investment returns often leads to big inflows, bigger fund size, harder to manage. So there's a very well-worn cycle. So I'm always looking at fund size, and that would be a reason to let a manager go.
For people listening, like I guess for Aussie large cap, do you have a sort of number where you'll start scrutinising it a little bit closer? Like,
I don't have hard and fast numbers. If I went sort of across the spectrum, smaller company managers, I think a good number is somewhere around between 500 million and maybe 750 million or something like that. Mid caps, it's can be a couple of billion, or probably a little bit bigger in the size of the companies. A good large cap manager can handle 5 billion of FUM, but past that, I'm starting to think, well, they must be pretty good to do that, because a lot of managers, as I say, if you to get alpha, if you to get this performance above the market, you've got to be doing something different to the market, which means you've got to be holding stocks in different proportions to the market. And a lot less stocks than what the market has. So you start to make very big bets. If you're managing $5 billion and let's say you had a 20 stock portfolio, every bet there is, 400 million. That's reasonable size to start throwing around. So it's tough. It's a lot tougher.
Yeah. With the world changing so fast, Chris, how do you ensure the fund keeps up with the evolving market, what's happening on us around the world, and sort of remains relevant to the investors?
Well, I guess the biggest thing for relevancy to the investors for my fund is it's Australian equities. So is an Australian equity exposure relevant to investors? Now, I'm not sure I can influence that, but we do know the health of the Australian stock market is pretty important. I mean, it is a shame that we're losing a lot of companies, either through M&A, other companies taking them over. We've lost a lot of companies. There's been an absence of IPOs in the last 4 or 5 years. So, it's hard. And meanwhile, the world stock markets have been bounding ahead in size, obviously, particularly out of America, led by the tech sector. So it's, I'm a big advocate of having a strong local market. Yeah. I think that's really important. And if I can have any influence on that through some of my activities, probably not Third Link, but, big industry funds have a lot to say in that. Government policy might have a say to that. Things like whether you're dual listed or not. It's currently a topic people are talking about. Seeing the IPO market loosen up more, which there's signs that that's starting to happen. That's all good. So if Australian equities is relevant, I would say my fund is relevant. Then I've just got to make sure the underlying managers are all still keen. Yeah. One thing too, an underlying manager who's really good, they can make a lot of money, and sometimes money does motivate a lot of people, surprise, surprise. And if they've made enough, they mightn't try as hard. So that's where you look for, again, either groups, people who are very hungry still, or you really do understand them well enough to know money doesn't drive them. They just want to win. They want to win the investment return game. They don't want to win the fun game, and they don't care how much money they have. They're the people to find.
How do you find them though?
Years of experience.
Yeah.
Years of. Well, you do tend to notice though. I mean, people who are really dedicated to their craft It doesn't have to be investment management either, whether it's a carpenter or a great artist or whatever. I said before, they become very focused. They are 24/7 people. You can bump into them in the street on a Sunday and they'll talk about stocks.
Yeah.
They eat and sleep stocks. They can't wait to, anything. They're sort of junkies.
Yeah.
That's what you want.
Yeah, definitely.
It's come full circle. You started by saying they're a bit weird, and we kind of ended there as well. I guess, Bryce and I, when we sat out to sort of prepare for this interview, we really wanted to pick your brain on finding good managers, because that's one of the big challenges for advisors, navigating this world and then putting them together in a portfolio. And I think we've covered a lot today to sort of understand your criteria and what you're looking for. As we wrap up today, is there anything we haven't asked you or any insight you want to share with the advisors listening to help them navigate this world and find good managers?
Well, I guess one of the hardest things for advisors, if they find a manager who turns out to be really good, and as I say, it's a little bit of a trailing type of game. You're watching what people have done, rather than you can't watch what they're going to do, but you're trying to predict that. But if they're on a good manager, the problem is always the good manager gets too much fun. Too much money pours in, and then that cycle that their performance will tend to come off with size. So, my advice to advisors, or they'll have their approved product list or their research house they use. They have to stick with managers who will stick with a confined fund size, funds under management size, and again look for the warning signs of managers who are clearly turning into fund gatherers. I mean, I hate to say it, but one of my big red flags is when a fund manager lists on the stock market. It's not a good thing. It ends up as a conflict because their shareholders want to see growth in fund, because that leads to more fees. So it's very tough with that.
Yeah.
Well, Chris, to close out, how can advisors listening support all the work that you're doing?
If Australian equities exposure is what they or their clients are after, and if they like the sort of structure of Third Link, and if they have a belief I have any skill in this area, Third Link has a website, thirdlink.com.au, and everything is there. And what's interesting too, I don't know if I made it clear before, I said I invest in about a dozen managers underneath, and I'm in specific funds of theirs that are public funds that anybody else can invest in. So if people want to really interrogate my portfolio, they can just look into the portfolio of each of the underlying managers. So my structure and setup is extremely transparent, which I think people want to see.